Hello everyone and welcome to Basics with Himang. So all of us love the idea of returns, be it higher profit, quick gains, and that feeling of success when our investment finally grows. However, there is one thing that quietly sits behind every reward, and that is risk. So the problem is for most people, either they fear so much they avoid investing, and those who actually invest, they invest without understanding the downside of the risks while chasing higher returns. So in this video, let's talk about how risk and reward actually work and how one can balance both like a smart investor. So let's begin. So risk basically means uncertainty. That is the possibility your investment might not give you the returns that you are expecting. But remember, risk doesn't always mean loss. It means variations. Sometimes it is up and sometimes it is down. So for instance, if you keep your money in savings account, that is almost risk free, right? But you will end up earning only 3 to 4% of interest, and that is quite low. On the other hand, if you invest in stock market, there is volatility, but over a period of 5 to 10 years, there could be a chance of higher returns, hence higher reward. So risk is essentially not that bad. It is just the price we are willing to pay for that potential reward. So there is a universal rule in finance: higher the risk, higher the potential reward. So keyword here is potential, which is not guaranteed. So think of it as climbing a mountain. Higher you go, the better the view will be, but with steeper and challenging climb. So goal here is, not to avoid any mountain, but just to understand which one you can climb safely. So let's look at some of the common risks that investors face. The first one is market risk, wherein prices fluctuate every day. Second is inflation risk, wherein our returns they do not beat the rising cost. Third is liquidity risk, wherein our money is stuck and withdrawing our money is not easy. Last is emotional risk, wherein out of fear or greed we end up taking a wrong decision. And trust me, emotional risk is something which is the hardest one to control. So as an investor, we cannot completely remove risk. We can only manage it, and there are some smart ways to manage. For instance, we can stay diversified. Whenever we are investing, we can invest from long-term perspective, and we can stay consistent. For example, we can utilize whenever the market is down or whenever there is an a potential bull run in market. So we can utilize these instances, and the last one is quite important, which is to know our comfort zone. That is how much risk we are willing to take for a given reward. So the goal is not to avoid risks altogether, it is to understand it and then take better decisions. Because risk is not our enemy, it is an entry ticket, I would say, to a long-term growth. So I hope you liked today's video, and thank you for watching, and I'll see you soon.